Toast. Ladies and gentlemen of the crypto space, we're live at 11:34 a.m. Flying a million miles an hour this morning, so a little late. I didn't really think of a title for the stream, but Q&A crypto talk. That's ultimately what we end up with anyway. So it's all good. Let's do some Q&A and have some fun while we're doing it and come up with some good ideas and figure out how to do things better, more strategic, more rational, less risk, and stop shooting for the moon. Because that's how folks get crushed. And that's what I need to remind everyone, 10, 15, 20, 30% interest doesn't exist in legacy finance, but it does here. And those are incredible numbers. And we work. So instead of trying to make millions, work and save. Because you can actually save with the products and infrastructure that crypto has built. And this is really all in the last year that it has come to fruition. It has emerged into a sustainable and growing ecosystem with monetary velocity that makes the legacy financial system seem pathetic. And I sometimes feel bad saying that, but it's true. You can't win. I see bank social media posts on Twitter where wealthy are flocking to Florida and Bank of America is setting up these wealthy people accounts. And I'm like, what the fuck are these people putting their money in banks for? Getting 0% yield, or whoopee-doo, you get 2.5% on a CD. What's the matter with these? What's the matter with these people? That's crazy. It's crazy. These people are crazy. They're literally not acting in their own fiduciary well-being. I don't even know how to explain it. They just don't know. They must just not know. How could it be so many wealthy people just don't know what's in their best interest? How did they get wealthy? They literally just are oblivious to what's going on, probably politically as well as technologically, no doubt. Anyway, let's get this ball rolling. Q&A crypto talk, yield, risk, strategy. Today's episode is sponsored by Change Angel, the non-custodial swap exchange for social goods. Stop depositing on exchanges, not your keys, not your crypto, non-custodial DeFi, or nothing at all. Bam! Let's pop it over to main screen and see who's in the stream. We got ArmorFi up. This is pretty cool. It goes through your accounts and it'll tell you what kind of insurance you could get. Obviously, considering what's available. So I don't think this covers a lot of what I would need it to. So, this is where you go to like directly to Nexus Mutual and you can get contracts directly. That's what Nexus Mutual is. But, as I keep observing for myself personally and I look over whale accounts, accounts that have just hundreds of millions of dollars and they have very little insurance. These major protocols have been very de-risked. They have billions of dollars of TVL. They've been operating for the better part of a year. So there's something to say about that. Let's go through the stream. Winter in training, my man. How's it going? Always a pleasure. We keep it calm. We keep it real. Carlos in the house. Crypto shills scaring people about impermanent loss due to recent ups. That's crazy. The impermanent loss is not impermanent loss. It's I appreciate why social media and platforms went with that phrasing, but people are afraid of missing out on upside, yet no one thinks about protecting downside. So impermanent loss protection or impermanent loss is basically a double-sided pool. I'm sure you could have double volatile assets, but the protective pairing is volatile paired with a stablecoin, which offers dollar value stability. So instead of impermanent loss, dollar stable. That's what these pools offer, dollar stability. And yeah, I know most people are interested in dollar stability. So permanent loss is a good thing. These shills have no idea what they're talking about. Now, Bancor is a big deal because dollar stability sacrifices upside. It sacrifices full risk on exposure. If you want to hold Ethereum, and have dollar stability, you could pair it with a stablecoin in a double-sided pool. There's a lot of them out there. If you want to hold Ethereum and it goes from 2,000 to 10,000 and you want to experience that, knowing there's risk that it could go from 2,000 to 800 in a bear market, that's why Bancor is changing everything. No other AMM can provide that type of functionality. So there's pros and there's cons. And then the whole point is to balance your portfolio, being risk considerate, knowing the difference between full on exposure has full upside and full downside potential, and other aspects of the portfolio more conservative, reduced risk profile, are dollar protective. So over time, as your risk on assets generate more value, the logical and rational course of action in portfolio management is to shift from risk on to risk off. Now, clearly, if you're very bullish about the markets, you could be more risk on, grow more value, accrue more revenue, and accumulate more capital. And then as you get more bearish about the markets, you shift from risk on to risk off. Now, this is exactly what everyone has done since the beginning of modern capitalism with bonds, 60-40 portfolios, and you go more risk on, you're more into equities, and everyone's scared the market's going to collapse. You go risk off, you go into bonds. So the difference is you can't really. I mean, sure, you could have Stephen Van Meter and Jeff Snyder and other brilliant contrarian minds that have great argument for bonds being not just safe haven, but also the appropriate play in many regards for whatever portion of their portfolio they see fit. But aside from the contrarian play, it doesn't fit traditional portfolio construction. 60-40 portfolios, you're done. You can't do it anymore. You're going to make no money and you're going to take excessive risk. So I'm not a fan of risk, which is why I don't allocate the vast majority of value to the legacy financial markets. I think there's enormous risk, excessive risk, and I'm not interested in risk. I want reduced risk profile, steady, reliable, predictable dollar stability with small portions of the portfolio allocated to risk on to appreciate and grow. If I could get 20% a year on the whole portfolio, woo! Now we're talking, boys and girls. Digilites in the house, always a pleasure. Frank's in the house, been following for a couple of weeks, learning, growing. Greatly appreciate you sharing your time and knowledge. It is my pleasure. I hope it helps. Did you like Cosmos at 5 APY, risk off? No, Cosmos is risk on, but Cosmos is yield bearing. So nowadays, if you're not making yield, you're missing out on probably the best opportunity in a lifetime. The yield is only going to dilute. Value and capital and liquidity are just going to continue to flow in this space. And as you can see, what I have up on the screen, you're not going to be getting yields like this. You got 230. This is why I have this up on the screen, because there's a liquidity crunch going on right now in Aave. Yeah, as you can see here, 234 mil, give or take, in available capital in USDC, and 233.85 are being borrowed. So when the borrowing gets close to the available capital, the yields skyrocket. 66% in the stable. They skyrocket to prevent borrowing because there's very little capital left to lend. And the yields for the lenders also skyrocket. So anyone who's got USDC and up in Aave is making 26% on their dollars. Crazy. And good old Gemini, GUSD. This is my favorite because this is by far the easiest asset to get your money out of the crypto space. You literally go on one inch, you swap to GUSD, you send your GUSD to Gemini, and Gemini automatically converts GUSD to dollars. So it's literally deposit to Gemini and you just withdraw to a bank account. It's that simple. So GUSD, for me, is the premier way to get money out of the crypto space. It's literally like 2 steps. It can't be any simpler. This is a heck of a liquidity crunch, so I don't entirely know what's going on, but I think folks are leveraging up because they're very bullish. But seriously, these rates are crazy. I don't know who's taking debt at these rates, but the appropriate course of action is when debt is low and these stable borrow rates are low. That's when you borrow capital. I mean, you got, look, USDC at 11% on average. If you could lock in a borrow rate of 8%, you're making a clean 3% on your collateral, which is basically paying your loan and your what's it called? The your the loan to value LTV ratio is stable. You don't risk any liquidation. You lent dollars, you're borrowing dollars, and the difference between the stable rate and the average interest on your collateral is 3%. It's positive. You're literally, your loan stability is improving automatically. It's automatically paying off the loan. You can't get any more awesome than that. And the reason you use this type of debt sequence or debt strategy is optionality, because you take the debt and you do whatever you want. For myself, it's predominantly interest bearing, MUSD nowadays, which is really cool. M stable. You're getting a clean 40% on your money up in here. 30% USDT, so the average is probably, the upper 20s, lower 30s, and then you're getting another 11% on the IMUSD vault. So you're getting serious return here. You have 40% on dollars. That's crazy. So the top it off, you get 40% there. The loan is paying itself off. Depending on what stable rate you lock in, it should be lower than the average, and your Aave balance is going to be going up. And guess what? Because you probably want a healthy loan to value ratio, you're going to significantly over collateralize. Borrow 25%. You take 10 grand, you borrow 2,500. Your collateral is going to be significantly increasing in value as compared to your loan. It's really cool. So that was my answer for Cosmos at 5. So that's a big deal because Cosmos is risk on, but I think Cosmos is a multi-year play. It's so risk on being a small percentage of your portfolio. It's up significantly. So it was once a small percentage of my portfolio, but has grown to be a significant percentage. But I think Cosmos is going to be up there with. Let's look at the top list. Didn't Polkadot pass Cardano? Yeah, that's crazy. So you know what's happening, guys. Look at Uniswap at number 8. Uniswap's going to be right up there. It'll bump out Tether. It'll bump out XRP. Let's go down the list now. What's going to bump stuff out? Aave will bump stuff out. Cosmos is going to bump stuff out. Avalanche is going to bump stuff out. Solana is going to bump stuff out. Synthetics is going to bump stuff out. Keep it going. Algorand probably be up there. Elrond definitely be up there. Sushi's going to bump stuff out. But Filecoin's hot, but I don't know how far it's going to bump out monetary velocity. It's a different fundamental. Celsius will get up there. I mean, just you see what's going on. UMA is going to get up there. Bancor is going to get up there. Urine's going to get up there. Phantom probably will catch up. It's going to take some time. It's an L1. Ren's going to get up there. 0x is going to get up. It's all just going to shuffle. XSushi will be up there just with sushi, but it has a smaller market cap just because it's not sushi. It's locked sushi, which offers 5+% interest derived from transaction fees on the platform, which is really cool. 1inch is so undervalued, 600 million. Oh my god, so undervalued along with Curve, which is probably on page 2 at this point. I believe Curve is in 300 million market cap. Look at that, 562. That's so undervalued. Oh my god, it's horrible. Pardon my flagrant tone. Balance, it's Nexus Mutual. You see where the Kyber, that's where the top 20, top 25 market caps are going. It's all going to just recycle or reshuffle, better said. Chainlink will be up there. This is all going to get reshuffled. It's all. This is the foreshadow. Ethereum, Binance, yeah, I don't think much of it, but whatever. It's up there because people are using it, and that's the point. Whether there's a security breach and the centralization topic, for United States citizens, it's a completely useless platform. You're not even legally allowed to use it. How about them apples? So I personally don't care for it at all. But the rest of the world, and they don't care that it's centralized. It's not going to significantly change the way the future heads. It's not a world-changing platform. It's project by a company. It's not Polkadot, Ethereum, Cosmos. It's not even Cardano. I mean, Cardano is gonna be better than Binance. So and Uniswap. I mean, you see where the top 10 is shuffling to. It's obvious. That's not to say strategically how to allocate value. Fundamentals tell you where to look, technicals tell you when, and only you could assess your portfolio balance, position sizes, degrees of risk tolerance, and yield that you're looking for. So there's a lot more than just a person naming names. And I'm not naming names, I'm just pulling out a list of CoinGecko. The stuff that has monetary velocity, money flow, lending, borrowing, interest, transaction fees, options, synthetics, derivatives. This is a financial system, boys and girls. The legacy system could bugger off. This shit is better. You think when I took a loan out on Aave, there was questions or it took a month? It took 2 seconds and I clicked a couple of buttons and I provided collateral. No paperwork, no underwriters, no nothing, no people. This is better. It's awesome. How can YFI afford to pay 206%? They're not. The Yearn Vault is a strategy that involves lending and borrowing. So however that strategy works, I know Bantech and Yearn folks are working on visual tools to aid in displaying how the strategy works. So, I mean, this is the same thing like what Alpha Homora does in V1. I have V2 up, but there's leverage in V1 that gives you up to 100%, 150% returns, and it's leverage. There's risk. There's risk associated with it. But Yearn is such a low market, a low supply asset that it makes sense, and it's such in demand because it's such low supply that I'm not surprised that they're achieving such leverage. And I myself have a little bit. I have one in the V2 YFI pool, earning 206%. Now, bear in mind, it's down. I've lost value on it, but I like the way the chart looks. This is a bullish breakout, a retest of support twice, and currently it's resting on previous resistance. Pretty much flip support. What you want to see is a break of the higher high, just like what I tell everyone all the time. Breakout, retest, and you get the higher high. And those are good times. No, I've had this position probably up here. Got a little ahead of myself, but it is what it is. And, it's all about patience and time horizon. You have to define your time horizon. I flip in and out of trades. I lose money here and there, but the vast majority of the time, I focus on the portfolio structure and the balance, and I'm thinking about where things are going to be at the end of the year, where things are going to be next month when I got to cough up a bunch of money for taxes, my strategy for paying taxes. Borrowing, I'm going to be borrowing money to pay taxes. I'm going to borrow money from Celsius. The IRS lets you borrow, I believe, for my situation, up to $50,000, and they charge you 0.25% interest per month up to 4 months. So you borrow. It's 0.25% interest. When you're making 40% a year on some of these positions, you pay over time. At least that's my rationality. So a lot of what you have to learn is proper debt management. A lot of people see debt as something you pay back indefinitely. And that's obviously prevalent with credit cards where people take months and months and years to pay back credit cards. So one of the most important things you could teach yourself is how to have significant debt and have it serviced and have it serviceable and have it paying itself off and how to manage it responsibly and intelligently. You think these big corporations don't have billions and billions of dollars of bonds, which are debt? They owe money. Most owe more money than they actually make. So a good part of fiduciary, self-fiduciary responsibility is intelligent and responsible debt management. How about them apples? Class is in session, Wave. Yes, my man. Matt's in the house. Always a pleasure. Vortex in the house. Yes. Ben Annett. Oh, I got so many comments. I missed it. Sorry. Boys and girls in class, yes, sir. Brian, borrowing stablecoins for Aave like 30% APR today. Does that fluctuate pretty often? It fluctuates in real time. Goes up and down depending on demand. So Aave is not something to get in and get out, get in and get out. That's not the way it works. Aave is your bank account. It's what it is. I told my wife the other day, here's your bank account. You need to know how to manage the money. If you need access to money, here's your money. You convert it to GUSD and you send it over to the bank. Send it over to Gemini and then you send it over to the bank for conversion. That's the money. That's the way the house runs the money. So that's it. Well, James says legacy banking is pretty pathetic. You keep cash in there because that interacts with credit cards, but BlockFi is changing that, and probably Aave at some point will have direct credit card access. Uh, and you could pay everything with a credit card. You could pay more. You could pay everything with a credit card. So if you could pay everything with a credit card, and if you could pay uh, credit card bill with crypto, what the fuck's the point of a bank account? It literally does nothing. Who gives a shit about writing checks? It literally, if someone asked me to write a check, I tell them no. You want cash? I'll figure out how to get you cash. I'll use a debit card at an ATM. Get you cash. Ridiculous. Larry, daily reminder, you're the man. No, thank you very much. I got to remain humble. I'm not the man. I just have a lot of experience, and this is what I do. This is where I spend a lot of my time. I think it's worthwhile effort, and I think it's good for me, my family, and I think it's going to help a lot of people. And a lot of people are going to need help. The system is pretty bad. So many people unemployed, and when they finally get employment or income, the first thing people think to do with money is spend it, and that's the last thing you do with money. The first thing you do is you set up a business. Always. You take your money and you generate revenue. If you come into $2,000, you don't buy an iPhone. What you do is you put that money into an account that generates interest. If you get in 10% interest, you have $200 a year. Spend the $200, but over the course of a year, and try and make more. You make $1,000 a week, you throw it into your account, and now you're making more money per year. You're building a business. You could get 10, 20, 30, 40, 50% on your money every year. Your goal is simple. Accumulate more of it so that your business is generating more and more money. And you're building your business. You're creating your employee and you're growing your salary. And as you work more, you're trading time for money, time for money. Your employee's salary will continue to grow because you're taking the money you make from trading time for money and you're converting it over time into your employee. You spend the money your employee makes. You don't spend the money that you make trading time for money, because if you do that, you're fucked. You'll never get anywhere. You can't save money like that. They don't give you enough. And it's a fallacy. It's failed. That type of financial strategy doesn't work. So create your employee. That's the only way to look at it that makes any sense to me. Rook risk. For Lewis, my man, always a pleasure. Yeah, big risk. It's a risk on. And what do I tell everyone about risk on? 1%? 2% of a portfolio? I mean, I personally gambled very extensively with Rook and had a massive position at $65 and it went to $800. But with great risk comes great reward and could also devastate and destroy people's portfolios. So everyone individually has to assess that risk and take responsibility for destroying their own financial well-being. But don't do it. If you're watching me on this stream, don't do that, guys. If you have a portfolio of $10,000 and you're gambling with $1,000, all right. You lose $1,000, you didn't destroy your financial well-being. But if you turn that $1,000 into $5,000, you changed everything. So the whole point is fundamentals tell you where to look and technicals tell you when. If the technicals look pretty bad, don't take the risk. There'll always be another technical setup. I mean, seriously, look, this is my favorite asset in so many regards. And because I don't have to look at curve, because I have a good curve position. And a V curve I consider a purchase. I don't even consider it part of the portfolio. I bought it. That's just the way I mentally handle that value allocation. So 1 inch is something I have my eye on because it's, to me, it's undervalued. But this is, the fundamentals are incredible. The automated governance system, the way they created the DAO, and I really like the way they handled the business. I believe they went corporate, and that's a big deal to me. Um, I think that I think I see how each one of these AMM platforms have handled their organization and where they're heading, and I have a little bit of a vision, and they're all doing it a little different. But I believe they'll all be titans of industry. So the whole point is the fundamentals are strong for all the major AMMs. What do you got? You know the major AMMs: Curve, uh, Bancor, Uniswap, 1inch, Balance Labs, Kyber. Sushi became because they were bought by or consumed by FTX, which is massive centralized exchange. So fundamentals tell you where to look, technicals tell you when. If this thing broke down below the red line, that's your bear signal. You liquidate your position, you take your loss. That's the way it works if it broke down. But this is a relatively large symmetrical triangle, so I have a small position, maybe a 0.5, 0.34% of my portfolio is a tiny position. But that position's earning 20% a year. How the hell can you apply value to a position and not earn interest nowadays? If you're doing that, you're missing out. But the goal here is to turn, some money into 400, 500%. There's no reason this can't run higher. But the whole point is, if it breaks out and then it breaks down and boom, you sell. You have to sell for loss. You cut your losses. Now, I'm not a trader. I'm not in and out of positions. But technicals tell you where to look. You don't want something that's not set up. You don't allocate value unless there's a trend formation. And look at Ethereum. Has a lower high and higher low, and it's fighting with resistance. This is a good place to take a bet. If you're extremely risk adverse, you wait for exactly what I tell everyone to wait for, the maximum bullish confluence. But here's the kicker. A lot of folks run around just holding Ethereum. Why are you going to hold Ethereum if it's not guaranteed to go up? If you're taking a risk on position, it's a small position. But if you wait for the bullish confluence, that's when you apply risk on. And the vast majority of the time, you're holding stable coins in Aave for 20% interest. And then when you want to get a risk on, you borrow some money at 9% interest when rates are actually manageable. No one should borrow at 38% stable, and never borrow variable. I would never borrow variable. But I got stable rates right now. I'm borrowing at 9% on average and making 26% on USDC and 28% on GUSD. And I got 9% stables. Yeah. So take less risk. Take less risk, please. Everybody, risk the TF off. Oh, so Lewis, the story has not changed. Rook is an awesome asset, and Keeper DAO is a big deal. Are they probably distracted with FTX and Ren? Sure. That doesn't diminish the fundamentals of the project, of what Keeper DAO can be. But fundamentals don't tell you when to invest. Technicals do. Respect the technicals, respect the portfolio, and your portfolio will respect you. Chet, my man, how are you, my brother? I was off Monday, but I'm back in action. Always a pleasure to see you. Barrett's in the house, new to your channel, been watching your past videos and learned a lot. You're very welcome. It is my pleasure. 5 days a week is the name of the game. Aaron's in the house. Holland, present. My man. Pellets, always a pleasure. Let's keep it going. Barnbridge launched their first fixed yield product on the 15th of March. I've had my eye on Barnbridge. I don't allocate value to anything new. I like my stuff old and tested. I don't take risk unless I don't take risk. I avoid risk as much as possible. John McGuire, hey Noah, how do we follow whale accounts? Is there a tool? Yeah, Zappify. Here, I didn't get to it the other day. Let me show you. Oh, where did it go? Damn it. I wanted to show you guys this. Zapper. Here you go. Let me show you guys some fun stuff. Ooh, Check this out. This is my favorite account to follow. This guy's got a couple dollars, you think? Oh, it's still going. How about that? This guy's running around with 562, 600 million. He does something similar. He plays with compound. He's a little too risk on for my taste. He has a lot of Ethereum and a lot of Badger. Yeah, I mean a lot of with WBTC and RenBTC, and he applies it to Badger. It's not what I would do with my portfolio, but he likes that type of. This portfolio takes a lot of risk. He makes a lot of decent a yield. A couple 100,000 a week, close to $1 million a week. I think a lot of it's accrued, so it's not necessarily weekly. Best represented weekly, and this is that display right there. Has very little insurance, barely any insurance. Has a large keeper DAO position. He also provides a lot of Rook liquidity. Pretty sure he has Rook, or maybe he exited on Bancor. All right, he's got a lot of money on Bancor, millions in BNT. Heck of an account, right? This is a great account. Let me 0x B1. Yeah, I'll put it in the stream for you guys. This is a good account to look into. You can't look at it in an Etherscan. You're going to want to look at it in Zapperfy. So let's close that bad boy up and keep going with the stream. So that account has a lot of money, and it's interesting to see how other people handle their money, and it gives you insight into strategy that you could implement yourself. Not that you should. I don't implement that account strategy. I think it's too risky, and I prefer a much more risk-off structure. Gonzo, what's good, Noah? Always a pleasure. Pellets, I'm pooling Bow with DAI earnings, 2,000% in Bow. Yes, that's not risk-off. You get 2,000%. There's something. Either it's not diluted or if it's not diluted, that means large capital holders are not allocating value, and they're probably not allocating value because it's an increasingly risky position. So, food for thought. I don't want 2,000%. If something's 2,000%, something's wrong. Quite often, you see like 1,000% pop up on Curve, and 30 minutes later, it's 200%. It's because the capital flows in because Curve has been relatively de-risked. I have no interest in risk. Watch your risk. Be careful. Lewis Haywood, rock and roll. Oh yeah. Jay Nice, Jay Nice. Bless Noah. Jamaica respect. I hope you have a nice beach and some nice sun today. It's nice out in Florida, but it's not the island. Enjoy. Is there a strategy to mitigate impermanent loss? So impermanent loss isn't a bad thing. If you want, I'm going to say rewind to the beginning of the stream. I talked about it. Impermanent loss is dollar stable. If you want impermanent loss protection, that's called the asset quantity stable, which means you have full exposure to downside risk. And that's important to consider. There's nothing wrong. The vast majority of my value is not in Bancor. I have a huge amount of value in dollar stable positions. So focus on the vast majority of portfolio being dollar stable, which are regular AMM pools. It's just for you to understand that most should be dollar stable or dollar protective. And then impermanent loss or asset quantity protective is risk on. And you need risk on for growth. Growth versus value. You quickly see the analogies with the legacy financial system. Nikolai, when we talk about diluting rates, do you have any thoughts on timelines? Yeah, when money starts to see the yield here, 26% in USDC, I got up on the screen. Who the heck wouldn't throw in 50 million? If I had 50 mil, I'd be throwing it in too. The only reason they're not is because they literally don't understand. They haven't been in this for the last year. They can't process that. How are you getting 26%? Because people are borrowing your money. And why is it protected? Because they're over collateralizing the position. They don't understand. That's it. It's as simple as that. There's no magic to this. This is one of the most important technological innovations in the last 100 years. Right here on the screen, it's Aave. And if you're able to capitalize on gains now, that just means you're early money. You're the smart money. You front ran the shit out of Wall Street and family offices and big money because this system is innovative, it's novel, it's nascent, and it's brilliant. Over collateralized debt positions. And at some point, they'll probably have under collateralized debt positions based on um, smart analysis, on chain data analysis to assess relative degrees of risk. If a person is creditworthy, assessed by actual data, on chain banking data, on chain blockchain data, you lend them money. But that type of system needs to be iterated on, and it will be here. But as of right now, the lenders on this platform, Aave, are taking little to no risk because the debt is over collateralized. If I have 10,000, if I have $10,000, I could borrow a lot because the collateral is stable. It's not volatile. If I have $10,000 worth of Ethereum, I could borrow a fair amount, but I need to borrow less to account for the Ethereum volatility. Because if my debt position becomes under collateralized, the collateral can be liquidated to make the lender whole. And that's the way this automated money market works. This is an automated money market. No people, no nothing, no nada, just software, no underwriters. Changes everything. So you do your calculations and you're literally just printing money. I mean, Aave today is just printing money. And where is it printing it from? People that are borrowing. And why are people borrowing? Because of the opportunity in the space to generate revenue by leverage trading or whatever they want. And that's the whole point of a financial system. Maybe they're taking the money out and moving into fiat and buying a damn house and generating rental income. This is a financial system. People borrow to generate revenue, and the borrowing generates revenue for lenders. So the only question you have to ask yourself is, do you want to be the bank, or do you want to be in the rat race trying to borrow to generate revenue? And for me, I'd rather be the bank. I want to lend money to other people that are working, and they're trying to make money. I'll lend them the money, and I'm protected by algorithms and over collateralization, and I generate my healthy 20, 30, 40, 50% returns on a yearly basis, and I'll let someone else go play around, try to make 5,000%. You go ahead, buddy. You go ahead and take your risk to make 5,000%. I'm going to sit back on a damn lounge chair making 30, 40, 50%, taking basically no risk at all. That's what I'm going to do. God damn it. Woo! Let's keep it going. Let's keep it going. Only the defiant shall survive. We see the direction everything's heading. James, sounds good to be too good to be true, and that's the last. It's not. It's the last thing it is. This is just technology and software and properties and protocols and platforms and monetary policy and monetary velocity and debt and borrowing and lending and interest and yield and gains and portfolios and all the shit that all the old people did with the legacy financial system. But this is a brand new market with $2.9 billion in it, which is basically zero. Basically zero. So if you're in this market and you're killing it, you are so far ahead of Wall Street, it's not even funny. Actually, it is kind of funny. You know what I'm saying? Sean says, I'm thinking about touching my 401k, but it seems like I should be thinking about moving everything out of my other investments, 50K, save some for taxes, and stake bank occur. You will have to make your own decisions. Exiting a 401k, I'm pretty sure, is a taxable event. I myself last year took the opportunity to reallocate a lot of value from retirement accounts. At this point, the vast majority of the value is allocated in the crypto space. I could never have done what I did in the legacy financial system. It just wasn't possible. You can't be a bank. You can't lend. This is automated lending. You can't do this. It's not possible. It's crazy. So tough choices. Pay your taxes. Token tax is, if you make good money, you pay the VIP package and you pay taxes. That's it. And that's the fun. I like talking about taxes because I pay the shit out of them. I owe six figures to the IRS this year, and I'm going to pay it. Of course, I'm going to pay it. It's what you need to do. Otherwise, they throw you in jail. And I don't want that. So I'm going to borrow money from Celsius. I'm going to borrow money from the IRS, and I'm going to generate money from my employee who makes a salary. Well, I sit back and my employee brings home the salary and says, "Here you go. I'm going to pay my debts. I'm going to manage my debts. I have a fair amount of debt in Aave. So probably when I take out money from like Celsius and I owe money to the IRS through their debt payment plan, I'll unravel my debt positions on Aave. And I'll lighten the debt load because you have to have a healthy debt to capital balance. And then when I pay off my debts, I could take on more debt from Aave to make more money. So pay your debts. You need to maintain solvency. You got to be able to pay what you owe. Just manage it intelligently. Pay your taxes. Token tax. Serious boys, serious software. And you're going to need it. Leo, how do you know I keep up the great contest by pleasure? Chet, didn't PayPal buy Curve? No. They bought CURV, which is something else. John McGuire, PayPal bought a. There you go. Nikolai, different Curve. They bought CURV. Yep. James, seems like a revolution is happening in banking. My man, a revolution has been happening. It's small and it's just starting because a couple $1 billion. It's like 40 billion, 50, 60, whatever it is. You go to DeFiPulse.com, you see how much money is locked in TVL, total value locked. It's starting. And if you're in now, you front run Wall Street. Simple as that, because this is crazy. 26%, and that's people paying you. They're paying you to borrow your money, and they're protecting you because if they want to borrow $2,500, they got $10,000 in their account. If they fuck up, they takes their 10 grand and pays you. You see what I'm saying? This over collateralization, you're protected, and you're getting significant yield. This is better than a bond. You get nothing with a bond. You get nothing with a federal United States Treasury. You get absolutely nothing. But you're getting money here, and it's protected. Candidates in the house, always a pleasure. Polygon Matic, thoughts on the story, use case L2. L2 is a big deal. So I was looking at Polygon. So I have them here, EasyFi and Matic. I was looking at it. It's cool stuff. It's the same situation as Loopring or Diversify and the L2s and the EIP 1559. The whole point is it's not seamless enough. I don't allocate value to Matic, and I liked Loopring for a while, but I've calmed down and I have different risk-on thoughts nowadays. But it needs to be seamless. And the other L2s are great, and the other L1s and interoperability and Polkadot and Cosmos and inevitably Cardano and Binance Smart Chain. I would, as a U.S. citizen, I would never put money on that platform because I'll never get it back. I don't trust it for a second, and trust and risk go hand in hand. But we see where this story is evolving to: seamless cross-chain interoperability. And whether that cross-chain is an L2 or another L1 doesn't matter. But if you look at the AMMs, if you look at like 1inch and Uniswap, at some point, you're not going to have to select the chain. It's just going to work, and it's going to automatically select whatever frickin' chain the contract is operating on, and it doesn't matter what chain you're operating on. What matters is the DApp presents the information to you, irrespective of the chain. So that's where it's heading. So I don't single out any one of them. That's why I don't apply value to L2s anymore. Albeit L1s are a different story because much grander fundamentals. I mean, Cosmos fits into the Chinese national blockchain strategy narrative, and Polkadot is a network of networks, and Flare is a big deal. It's not live. So many folks got excited about Flare, but it's not even released. And I'm interested in Flare. I'm excited for it. Flare has nothing to do whatsoever with Ripple. So all those Ripple people like Flare, no, it has nothing to do with Ripple whatsoever. Flare is inverse Polkadot and Cosmos. Cosmos and Polkadot have a central consensus mechanism, and then they have parachains and Cosmos hubs that draw consensus from the central beacon chain for Polkadot and Cosmos hub, whatever, for Cosmos. Whereas Flare does it the other way around. Flare draws consensus from all the integrated chains. That's big tech. Has nothing whatsoever to do with XRP. Not one iota. Zero. So, and this is not released. So people buying the futures, it's so much risk. Stop taking risk. Wait for it to be released, and I'll see what it can do. Fundamentals tell you where to look. Technicals tell you when. Serious technology, boys and girls. It needs liquidity. It needs exchanges. It needs volatility assessment, risk assessment. For the love of God, stop buying stuff blindly. You're going to lose all your money. Seriously. Vortex, thoughts on paths to work in the crypto sphere? Work, yeah, that's follow Pump, and there's he put something up for crypto centric jobs, which is pretty cool. And I'm working on it. I would rather work in that type of realm as well. Matt makes reference to Badger and Rook. Badger's cool. It's like I call it second layer DeFi. It has everything. It has the monetary policy, but it doesn't have the monetary velocity. No transactions, no transaction revenue. But it's a second layer DeFi protocol that has inflation and incentivized supply disruption. But it doesn't have necessarily deflation. I don't see any burn components. So keep an eye on the monetary policy. I tell everyone, if you want to find the money in the crypto space, follow the monetary policy and look for the monetary velocity. And that's where you're going to see the top 10, top 20 market cap assets swap up the board. Noah reveals his Wi-Fi entry as human. Yeah, I try and avoid some of these tabs. It has a lot of my accounts up, but Yearn's cool, and I held off a long time because I was waiting for the technicals, and I probably could have waited a little bit longer. But I think I'll be fine. I mean, shit, it's offering 206%, and Curve. This is dollars, man. This dollar is getting 47%. Come on. Come on, that's crazy. That you're fucking crazy to me, boys and girls. Who the hell's turning down 47% on dollar bills? I mean, if inflation, real general public inflation is 15%, this is some serious growth. And I'm not working. I'm not out on a roof and doing manual labor. I'm just literally clicking some buttons and earning 30% more per year, considering inflation. That's crazy. Macro Mind, market narrative seems to have shifted for KeeperDAO with L2. Can you speak on the necessity of the protocol once gas fees come down? They all place hand in hand. L2s interact at the L1 level. L2s have L1 transactions. Fundamentally, it's still an L1 world, even when L2s are popular. The narrative doesn't change much for KeeperDAO because there's always going to be an opportunity to save on MEV. EIP 1559, we'll see what happens in the next couple months when the upgrade rolls out, if it gets accepted by miners, whom basically are the DAO of the L1 world or of the proof of work world, because they have to vote. And how do they vote? By either upgrading the binary or not. So the narrative is still it's a risk on asset. You have to assess how much risk you're taking. I always tell you guys 1%, because if you turn $100, so Alpha went like 5,000%. If you put $100 into Alpha and you turned it into 15 grand, I mean, come on. You don't need to take so much risk to change your portfolio. Only risk money that you're willing to lose. Yeah, so stop being willing to lose money and do the opposite. Start protecting the shit out of your money. So that's what I would recommend. And yeah, if you're gonna gamble with 1% of your money, all right, fine. Well, it's 1%. You have 100 grand, and you gamble with $1,000. No one's gonna cry at the end of the day. But if you have 100 grand and you're gambling with 20 grand, that's gonna hurt. So, Nansen for whale tracking. That's right, Mr. Weeby. Cruz. Oh no, I lost it. Cruz, I'm wary to migrate my risk on into interest-bearing stablecoins, mainly over fear of inflation brought on by an increase in monetary velocity in a post-COVID world. Curious to your thoughts. Well, you need to account for inflation. So if you're getting 47% on dollars in Curve, or you're getting 200% on YFI, or 13% on Ethereum, or if you go over to Aave and you're getting 26% with an average of 11% for USDC, I think you're pretty much handling inflation pretty well in a risk-off way. And sure, if you want to hold on to Bitcoin, Urine, you're going to get 4%, 3.5% on WBTC, or you get 13% on Ethereum, like I said. Here, look, Curve St. Eth. You get 33% on your Ethereum. Curve SETH. You get 42% on your Ethereum. Urine's big tech. These boys are absolute geniuses. Let's keep it going. Keep it going. I'm going to get to everyone's questions before I have to get off. Almost too good to be true. Balance, balance, logic, and reason. Do you have sushi? I don't have sushi. Their monetary policy kind of annoys me with the 2/3 escrow. I do like the 5% yield on X sushi. I've had sushi and X sushi. You can provide X sushi as collateral nowadays on Aave, which is pretty cool. So I don't have it at the moment. That doesn't diminish its meaning, but the thought was their transaction fees need to go up because 5% isn't enough of a reason to hold X sushi. So that's just where my head was at when I made a couple of those choices. Zach, Noah, maybe you have mentioned it before, but what is your goal? You talk about creating income streams, Avi and others, but at the end of the day, how much are you trying to accumulate as much BTC? No, I'm interested in producing $200,000 a year so that I could stop working and choose to do what I want to do with my time. I get a financial advisor's license so I could generate money doing actually what I enjoy doing. Because as you can see, what I'm doing right here, right now, is talking about financials and risk management and value allocation and portfolio balance. And I would actually enjoy giving people advice what to do with their portfolio. Here's how you think about this value allocation. Maybe you want to buy this. Maybe you should buy this. I can't say those types of things without a financial advisor's license. I cannot make personal recommendations what people should do or could choose to do with their money. And if you notice, I talk about what I do and I tell people about the technology and what is possible, but I never tell a person what they can do, their options and choices, what they should do. So I have to be very careful with the way I present information until I have a financial advisor's license. So my goal is to generate a recurring revenue stream, turn capital into an employee, generate a salary so that I don't have to work and trade time for money doing what I don't want to do. And I want to get into the financial advisor's business. Looks like we're heading in that direction. James, do you change your risk profile depending if you're in a bear or bull market? Yeah, well, we're clearly in a bull market. 57,000. Yeah, of course you do. But I generally think I'm going to be leaning risk off the vast majority of the time. That's just my personal preference. I work, I trade time for money, and I take that money and I save it. I put that money into Aave and I save it and I accumulate. And when I want to buy something, take some risk on, I borrow. And I'm making more money than the interest I owe on the borrowing. So I always have that capital accumulating and accumulating and accumulating. So don't spend the money you make when you trade time for money. Spend the money your money makes. And once you get past that critical threshold and that psychological barrier, then you're actually able to grow wealth. You're able to grow your capital. Trevor Van Meter, the whale account and portfolio structure. Yeah, in my opinion, it's a mess. I don't agree with a lot of it. It's excessively risk on. But I guess that's their choice. They have to live with their choices. Yeah, it's massive. They have a huge amount of capital. John McGuire, Noah, how could we find a few other DeFi accounts to follow, learn about strategies employed? A good way is to go to Uniswap, uniswap.info, and find large transactions. And you're able to see the addresses that made the large transactions. You're able to track this. I've seen a lot of like 10, 20, 30, 40, $50 million accounts. I mean, it just doesn't stop. And that explains why we're at gas of $205 and people are throwing around $2, $3, $4, $500 transactions like it doesn't matter because you got thousands upon thousands upon thousands of accounts that have 10, 20, 30, 40, $50 million. Shit. They don't I don't stop for $100 transactions, and I'm not a whale. $100, $100, $100, $100, $2,000 a day in transactions, and these boys are running around with 50 mil. They don't even think about it. Click, click, click. It might as well be $2 transactions for them at $200 a pop. Seriously. John, a way to find large account. Yeah, that's what it is. Thank you for explaining. Spot on. You're welcome. Heirloom reprogramming my head for more DeFi. Reprogram, be the bank. These are good terminologies. Larry, what's your favorite battery metal mining play and where to look? Well, lithium, cobalt, graphite, and nickel. Um, the only one that's pure battery play is lithium. Graphite, cobalt, and nickel have other applications. Um, Follow Simon Moore's, and I've shown a couple of charts over the last couple of months, but you have to do your own research, and I don't really trust equities. If it wasn't for my equity positions being historic, like I've literally had them since like 2016, 2017. I probably wouldn't have them right now, and I just have all that capital in the crypto space. Um, but I think the value prop and the narrative for that value allocation is still spot on. So I hold those assets. They're much smaller than they historically were. But over the next 10 years, I think as Raul says, he thinks EM is just going to print money over the next decade, and I like his mentality in that regard. And I think the same for uh, if we have the commodity super cycle, but no matter what, whether there's a full-on commodity super cycle or not, I think there's so much money to be made with electric vehicles, and however, in the next 10 years, they're all electrifying. By 2030, you'll be like, if you choose to buy a gas car, you're probably not going to find many. That's what's playing out over the next 10 years. You're going to be going into a showroom and there are going to be 8 electric cars and 2 gas cars. And you're going to be saying to yourself, what am I doing getting a gas car, paying $8 a gallon for gas? When you can plug into your home electric charger that has solar on the roof and you're paying nothing for the gas for your electricity for your car, because that's what it's going to be in 10 years when solar panels are 10 grand for your entire roof and the solar panels pay your entire electric bill and can charge your car. Or yeah, I'm going to spend $300 to fill up my car, or free for charging my electric car. You got to think a couple of years out, 10, maybe 15 years, because that's where it's really heading, boys and girls. You're welcome, John. Chet, thank you very much, my brother. I appreciate it. I only hope to help, and I wish I could help more, which is why I've been spending a little bit more time on these streams. Gonzo says, I used to be a big risk taker, and now I'm not. Only OTC. Less risk, less risk. Mr. Weeby, that's crazy. Yes. Music Affair. Noah, can you please explain how I can pay my taxes with borrowed money from Aave? I wouldn't do it from Aave. It's too much too high a cost. You're probably looking at a stable rate. If you're lucky, you could get in about 8, 9, 10%. But the odds are your interest on your collateral is going to be more than your stable rate. You got to wait because right now, very high rates. But this is the same shit that people go through in legacy finance. You get a borrow from banks, you provide collateral, HELOCs and personal loans and equity lines of credit and all that shit. But this is no questions asked. It's permissionless. If you have capital, you can borrow money. You know your rates. The numbers are right here. You know how to lock in a long-term rate. You know your short-term loan rates, your fixed adjustable rates, or your adjustable rate loans, and you have your average interest that you're getting for providing capital. So from Celsius, a great place to borrow dollars. It's really convenient. You're going to get 1% loans. I'm pretty sure you could get the 25% LTV, loan to value ratio. You're going to get 1%. And I think you got 4 years to pay it. So personally, I wouldn't just take a loan. You got to know how you're going to pay your taxes. So you have to be strategic and well thought out. Just don't take on debt for shits and giggles. I mean, I have a lot of debt on Aave. It's because the debt is making more money than the debt costs. It's leveraged debt. Um, that's what it is. My man. Um, yes, you're going to have to pay taxes for the borrowed. No, you don't have to pay taxes for the amount you borrow from. Well, you have to pay taxes on the interest you get on your collateral. This is why token tax is absolutely critical. Listen, Celsius is going to send you a 1099. Token tax is going to do your taxes for you. You drop it in TurboTax and you're done. Don't think too much about taxes. Let's pay other people to do it for you. I'm done with all my taxes. I got a bunch of forms from BlockFi and Celsius and whatever. I plug it all into TurboTax. I paid a token tax, a bunch of money. It's like $2,500 for their VIP plan. I file a tax extension. I send a bunch of money to the IRS on April 14th. You know, good faith that I think this is how much I owe. File the tax extension. I file my tax forms on in October, and I pay the rest. Token tax needs more time to figure out how to handle what happened in the last year. This explosion of DeFi, it's extraordinarily sophisticated, but I paid a pretty penny because I need that kind of tax analysis and accounting analysis and audit protection and all that stuff. So I have the next year planned out. The most important thing for you to do is to have a plan. Attack this shit strategically. Execute surgically. If you have questions, get answers. Don't do things blindly. You need strategy and you need a rigorously defined course that you're following. Trevor, Noah's Ark, financial advisor, get on board, avoid risk, and get carried a bright ground in the future. Well, we'll see how that's going to play out. But I think people would benefit from my capacity to see markets and engage in risk adjusted opportunities. They could be fun for me and helpful for other people. Mark Twain said, a mine is a hole in the ground with a liar standing on the top." A mine is a hole in the ground, though. I don't get it, but trust. And Mark Twain, brilliant. So that's probably why I don't get it. I'm not the smartest cookie. In many ways, but not in literature. Never took a pension for literature. A music affair, and isn't it fee heavy to transfer from my loan from working to a stablecoin yield position instead of just using an ETF? And electronically traded fund? Are you talking about equities markets? You're gonna have to pay tax. Either if it's in the brokerage account, you're going to have to pay income tax, and if it's in a retirement account, you're going to have to pay whatever, whether it's a Roth or a regular IRA, you're going to have to pay tax and probably an early withdrawal penalty because back last year you didn't have the early withdrawal penalties because of the COVID bills. But this year you're going to have your 10% early withdrawal penalty. So it's tough choices. And I'm not able to give recommendations at this point or do financial analysis of your particular situation. But I can say you should. And if it's an opportunity, you can analyze that and make the most appropriate financial decision possible. And make mine, if we can make 40% interest on dollars, why don't we have a responsibility to tell our friends and family? That's what I do. That's what I do. And, they got 49 people and 51 people on the stream, 33 likes. By the way, we can do better. But I'm telling people I have a responsibility. I see very clearly things that could be done, choices that could be made, and strategy that can be executed. And this will help people. So what you just said is exactly why I started this stream last year. Mr. Weeby, I'm trying. You're trying. Keep it up. Keep it up. Chet, love the comment on Noah's Ark. That's not a bad idea. I'm from Germany, by the way. Music affair, probably another situation here, but love your content. Same exact situation, contextually different. You have to know your tax law. You're going to have to find a CPA, an accountant that has enough of an understanding of what the hell's going on in DeFi. Maybe token tax can help. They can help. But obviously, there's a lot of countries, and whether they can help with the specific tax rules of your nation. Inevitably, they will. Inevitably, these sophisticated taxes need to be accounted for, or the tax rules are going to change, or the tax rules are going to evolve. But yeah, the point being, whatever you do it, and do it well. And think things through, and be surgical with that shit. That's what I tell everyone. That's what I tell my daughters. I don't use that kind of phrasing, but I always tell them when you do something, do it well. Take it personal. Not none of that. Do your best. Do the best you can do. No, fucking kill it. Kill it. So whatever you do, kill it. Now, that's a bad phrase. I don't like killing things. But whatever you do, take it to the next level. Take it and put it in a headlock, for Christ's sake. That's a bad phrase. I'm going to watch my political correctness. But put it in a headlock. You know what I'm saying. Zach wants, do I want to adopt a 20-year-old? My man. I hope I was able to help or at least point you in some sort of a direction. I know that was complicated yesterday. You ping me anytime. You guys, all of you, Twitter, ping me. I'm happy to help to the best of my abilities. Keep off the private messages. Make it public, because if you have a question, I guarantee you other people want to know. Not personal shit, but like strategy and ideas and your questions about this technology. Other people want to know, and they need to know, because, as much as I know everyone wants to do what's right for them, we have to help other people. There's a lot of people hurting right now, a lot of people out of work, and a lot of people just simply don't have financial education. Whether it was taught to them or not taught to them, I didn't receive a financial education. I was called an autodidact. I teach myself. My entire career in programming was self-taught from Google. I literally Googled one day, how do I build an Android application? 11 years later, I've worked for the largest companies on the planet. So, same thing with this financial stuff. This is all Google. No one had to tell me how to do it. I figured it out on my own. So, let's get answers to questions on Twitter so other people could get answers to questions, and we could help as many people as possible make better financial decisions. Knock it out of the park. That's right, Nikolai. Let's wrap it up. 12:42 p.m. We made it to the PMs today on Wednesday, March 10th. Thank you all for joining. 53 people in the stream, 36 likes. We can do better. Tell everyone to subscribe, and it's still the middle of the week, so I will see you all tomorrow. You all have a good day now. Peace.